Hello everybody, it's Paul here on Monday 5th of November 2018. Here we are for the 15th session of the Mastering the 4 M's of Trading. For those who don't know me, my name is Paul Wallace. I'm a trader, analyst and coach, and I am the guide through this Admiral Markets webinar series on Mastering the 4 M's of Trading. As always, we'll begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying video is for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group, investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. To get the corresponding information on charting conditions and any other details, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. This presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of £50,000 sterling as per our negative balance protection policy. Why would you use Admiral Markets UK? Well, Admiral Markets offer a wide range of products and services. Two of their most popular trading instruments, the DAX 30 and the Euro Dollar, are typically 0.8 points or pips spread in there during the main trading hours. They also offer both the MetaTrader 4 and MetaTrader 5 platform, with also the Admiral Markets Supreme Edition. If you have any questions, please get in touch with your account representative and they'll be happy to guide you. Admiral Markets is a global brokerage. They may be one world, but they have a global offer depending upon what regulatory environment you trade from. By all means, please get in touch with your account representative and they'll be sure to guide you into the right and proper trading environment for you. So, ladies and gentlemen, as I said, I'm Paul Wallace. Okay, we've been through these sort of sessions for about 16 weeks now. I myself am a discretionary based method trader, primarily a dominant swing trader. I like to keep things very, very simple. I know that I'm a fear-based trader, and what I do is I meld fundamentals, technical sentiment, and geopolitics into building my trading decisions. Primarily, I look to trade on FX indices and commodities. And within that, I'm always looking to buy strength and sell weakness, and ideally use pullbacks for entries. My intraday trading is I'm primarily a mean reversion trader, and that is something we will focus on much later down on the Mastering the 4 M's of Trading webinar series. As always, I like to set my expectations for our sessions. It's for me to educate you about the 4 M's of trading so that you as a trader can go away and begin to analyze any market and be ready to trade it. I'm also going to work on helping raise your self-awareness about managing risk and managing yourself. For yourselves, ladies and gentlemen, I know that we always have a broad range of experience in the room. I also have time limitations of 45 minutes for our session, so sometimes that limits the depth within which I can go onto topics. So what I like to do is try and focus on tools that you can take away and use tomorrow. That's what my aim for these sessions always was with Admiral Markets, to give you an education, but also provide tools, tactics, techniques, and concepts that you can utilize tomorrow in your own trading. So what's the 4 M's all about? Well, it's about understanding the sort of markets, method, money, and myself. It's about understanding that we don't trade in a silo, and that actually there's a meld of all of those 4 areas. And when we are managing and mastering those 4 areas, that's when we tend to trade at our best. And if you find yourself struggling with your trading, well, it's about time to just conduct a little quick business inventory about how you are doing in managing and mastering those 4 realms of trading, and that will help you sort of work out where you next need to work on overcoming to evolve and develop as a trader. So if you've joined us for the first session, or you're watching this on demand, what we have been talking about here is, focusing a lot in the sort of first 15 sessions on sort of markets and method. And what I've talked about consistently is that, traders need, they need a little routine. Okay, they need process, they need habits, they need good behaviors that generates good behaviors. And what we've talked about is that, regardless of whether you are a monthly trader on gold or whether you're a 5-minute trader on euro dollar, we need to have sort of some good habits that we conduct whenever we sit down and get ready to engage with the market. And what we talked about here is, just a very simple checklist, a very simple process that we can follow time after time. Step 1, define our levels of support and resistance. Step 2, define if there is a trend. 3, look for how price reacts at key support and resistance levels. Step 4, look for price action signals at support and resistance levels. Step 5, which is what we've been focusing on for the last couple of weeks, is, are they part of a bigger chart pattern? Those are the 5 steps. And every week what I do is, as we add more and more, I just go through, as a quick recap, because, the way I look at this is that the more you hear this, the more you, sort of see this kind of process in action, the more it sinks into your own trading psyche, the more it becomes the, sort of your natural way of operating within markets. And that's the sort of message I want to try and get across about sort of, a consistent and disciplined application of effort within the financial markets. So step 1, define levels of support and resistance. Okay, so whenever you open a chart, look at the monthly, weekly, and daily charts and draw in those horizontal levels of support and resistance. You can also draw in any particular major psychological round numbers that we see. And if you are new and struggling, you can also use the fractals indicator to give you a hint of where particular strong levels of support and resistance may lie. Step 2 is all about defining the trend, okay? And I talk about this every week. As a trader, you need to show to me that you can identify whether an instrument is trending or consolidating. And, it might sound very simplistic, but you'd be surprised at how many traders, fail to achieve that on a regular and consistent basis. I say it every week, okay? You need to just be able to see, is a market consolidating or is it trending, okay? And I say it all the time is that, good trends will leap off the chart at you. If you're a new trader looking at a chart and trying to force to see whether there is a trend in place, I can assure you it probably isn't there. Okay, good trends leap off the chart at you. That's the way to work at it. All right. And as I say every week, if you want to go through these points early, please go back and pick up on the previous sessions. They are on the Admiral Markets YouTube channel and Admiral Markets global Facebook page, and you'll find in the previous sessions they are all there on demand, and you can go into these particular elements in far more detail. Here we are as this week. I just go through a very, very quick recap every week, just adding layer by layer by layer, building your knowledge and building your skills base. We also talked about utilizing moving averages. Okay, you'll see on my charts, a blue 20-period moving average, a red 50-period moving average, and a green 200-period moving average. For those of you who join me for the Tuesday morning London 10 o'clock real-time daily trading ideas sessions, you will know that that's how what I talk about in these sessions is exactly how I sort of analyze and look to trade markets. In those particular sessions. We talk about, not really using moving averages for sort of trade trigger signals in terms of moving average crossovers. But what it does do is, it gives us just further confirmation of the trend. We also get an idea of sort of the strength and the speed of that trend. And also, those moving averages act as significant levels of dynamic support and resistance. Okay, so step 3. Wait to see how price reacts at key support and resistance levels. All right. Well, say that. What does that mean for us? Okay. What does that show? Well, actually, What it is that, and I talk about this all the time, it's what we're looking for is a confluence of events. That's what it is. I'm looking for somewhere between 2 to 4 to 5 things all to come together at a particular time and place, because that is where I want to do business. That's what I'm looking for, right? And we're going to touch upon that later at the end of this session in the, let's say, the specific focus for today's piece. And we will be looking at how a confluence of events happens, and how it helps us to make decisions on what we want to do as a trader. Also, what we talk about, I say every week, print off this chart, take a screenshot, stick it up on your wall. Okay, when markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. Define the trend and trade with it. No trend, no trade. No signal, no trade. I know that some of the more advanced, experienced traders in the room who are watching these sessions may have a little bit of a different idea. But what we're looking at here is sort of almost a building, as I said, the most basic understanding and sort of consistent processes that help a new trader, right? And sometimes even those more experienced traders need to be reminded that we need to keep it as simple as we possibly can. Okay. All of us human beings, and can overcomplicate things, and I include myself in that quite happily. All right, and sometimes it's good for us to be reminded that to keep it nice and simple. That's what we want to be able to do. So, as I said, we looked at step 1, define levels of support resistance. Step 2, define the trend. Step 3, wait for price to react to key support resistance levels. Big round numbers, moving averages, horizontal levels that we see from step 1. And then step 4, we say looking for particular price action signals when we see them happening at those particular areas. And that's what we talked about for about 6-7 weeks, okay, in terms of we're entering more into the sort of focusing more on the method side of it, okay, and we talked about some particular price action signals. What we talked about was that when you boil it all down to it, okay, when you're looking at all the sort of trading ideas that are out there, okay, we can boil most of them down to one of two simple styles. You're either trading a break of a line of support resistance, or you're trading a bounce off a line of support resistance. Nice and simple. As I said, don't try and overcomplicate these things. What we talked about is, we're looking at certain candlestick patterns, price action signals, okay, when they happen at particular times and levels, when we see price actually break through a level of support resistance, or we see it bounce off a level of support resistance, that starts to get us interested. It starts to feed into that confluence of events of certain things happening time after time. So if you remember, pin bar, or sometimes called the high test, low test, the rejection candle, it's very simple. It's a very popular price action signal. Okay, what we can see is that for a good pin bar, the open and close should be within the range of the previous bar. The candle wick should be 2 to 3 times the length of the body. Long nose protruding from all the other bars, and the better pin bars, they will stick out and are very obvious. And that's very true. It's a very popular price action signal. And if you want to know more about what we talked about in particular details, as I say, go back to earlier sessions on the Admiral Markets YouTube channel, and they'll be able to sort of find a specific one where we focused on pin bars. And the reason is, we take an interest in pin bars is that they are a good indicator of where the biggest predators are lurking, okay, because it shows rejection of a particular area or direction. And as a private trader, it's pointless to try and fight them. Work with them to show the likely short-term direction. And ideally, we look to use them to sort of trade with the trend. That's what we're looking for. So after we did pin bars, we did engulfing candles, okay? If you remember, they happen rarely, but they're good probability, okay, because they demonstrate total psychological overwhelm. So we look for them at the end of trends, okay? It's a reversal pattern, so there needs to be something for it to reverse. So when we look for a bullish engulfing candle at the end of a downtrend, look for a bearish engulfing candle at the end of an uptrend, we trade in the direction of the close of the engulfing bar. Then, if you remember, we talked about a 3-bar reversal setup, a very simple mechanical sort of trade setup, okay? Where we're really just using what we've utilized so far. Define if there's a trend, wait for a pullback to support or resistance. For if we're in an uptrend and we have a pullback to an area of support, for a long trade, we need 2 seller bars followed by a buyer bar. Or for a short, okay, in a downtrend, we need 2 buyer bars followed by a seller bar. That's what we're looking for. And ideally, okay, what we're looking for, even if it's the most simplistic view, right, what we're looking for is that sort of 3rd bar, maybe the trigger bar, okay, is, if it's a pin bar or an engulfing candle or an inside bar or maybe a doji or spinning top, That gives us more confidence because they themselves can be utilized as reversal price action signals in their own right. So the more we see them happen as the third bar, the trigger bar, the more confident we become. Then we looked at inside bars, all right, inside bar, the opposite of the outside bar, all right, because in this inside bar, the high and low of the bar is fully within the range of the preceding bar. We like to think of it almost like an organism breathing, okay? Humans and markets, they surge, they rest, and they surge again. The inside bar is the end of the rest, and what we're looking to do is position ourselves to catch the next surge. That's what we're looking to do. So, we look to trade them as pullbacks and trends, for longer term traders, all right, okay, so you can utilize, if you find them on weekly and daily setups, you might want to use the 4-hour charts to execute and manage. We look at, so where we put our entry in based upon, the sort of size of the bar compared to the mother bar in front of it. And, we say beware of false breakout. So as always, as I say, if you want to know the sort of more of the details, when we covered one of the inside bar for one of the weeks, go and find that video on demand on the Admiral Markets YouTube channel, and you'll be able to get a good deal more detail. The inside bar can also work in true breakouts. So, what we do is, you can see there, we wait for a breakout to occur, wait for an inside bar to be printed, and then you trade that in the direction of the breakout. That's what we were looking to do. So, then we moved on to looking at key day reversals and momentum reversal candles, sort of two versions of a similar setup. If you remember, a key reversal it's a sharp reversal pattern that occurs during a trend. When we're in an uptrend, price opens above or equivalent to the previous day's close, pushes to a new high, but then closes below the previous day's low. In a downtrend, price opens below the previous day's close or the similar for the FX market, makes a new low, and then closes higher than the previous day's high. That's what we're particularly looking for, a key reversal candle. Doesn't happen very often, but when it does, it's very, very worth sort of being aware of it and getting ready to trade it. But what we also have is, the momentum reversal candle. Key day reversals, okay, they don't happen as often as we would like, but, a version of them appear more frequently, and we call them momentum reversal candles. Some people would call them swing candles, but for our purposes here, we'll call them MLCs. So for a basic long setup, how this differs from a key reversal is, price is in a downtrend, price makes a new low, but actually it reverses and during that session, and it closes higher than the previous day's close. Okay, the KDR will close higher than the previous day's high. The momentum reversal candle will close higher than the previous day's close. So it's not as strong as a key reversal, but when they occur at the right time and place, when you have that confluence of events occurring, they can still be very, very good trade signals. Then we looked at 1 week a little bit of a sort of a combo setup between the 1, 2, 3 pattern and the key day reversal. And what we talked about was how when I see a good trend happening, I start to take an interest in it when it prints an individual reversal candle on the daily or the weekly chart. That could be a key day reversal. Very often that means it could also be an engulfing pattern or a pin bar or a rejection candle. Then what happens is I wait for a 1, 2, 3 pattern to form, which provides me with a lower high. Because remember, if there is a reversal, I'm not looking to try and pick the exact top. Okay, that's not my game. I think that's a bit of a mugged game. What I'm looking to do is for it to provide a lower high, and that gives me an opportunity to sort of take a position. Ideally, what I'm looking for is the 0.3 of that 1, 2, 3 pattern. If it is a rejection or an indecision candle, something like a pin bar, an engulfing, spinning top, or maybe even another key reversal, that starts to get me very, very interested. Part 4, which is what we're going to focus on a lot of later on today, which is optional, but gives us the best results. Ideally, the 20-period moving average, if you remember, that's the blue one of my charts, or whatever fast-moving average you may utilize yourself, should now turn, from support to act as dynamic resistance when we've come to the end of an uptrend, because it acts as a roof capping any further move north. So, there we looked at, some particular price action signals. And then a couple of weeks ago, we moved on to step 5, which was about general chart patterns. What we looked at is, the lines of support and resistance that we draw on charts, okay, they actually can create various chart patterns, and they in themselves can actually be traded. We tend to have two types of patterns: continuations and reversal patterns. Not, no real big surprise. Continuation pattern, we expect the trend to continue, okay, in the direction that it entered the pattern, and as a reversal pattern, we expect the actual trend to reverse. Don't need to be a rocket scientist to realize what that means. We have focused on continuations, but last week we started to look at reversal patterns, okay? So if you remember, for continuation patterns, we looked at bull and bear flags, ascending, descending triangles, symmetrical triangles, and reversals, okay? About, I think it was a week or two ago, we looked at head and shoulders, double tops and bottoms, and triple tops and bottoms. Remember, okay, for continuation flag patterns, we had bull flags and bear flags. That's what they particularly looked like. We had ascending triangles and descending triangles. Okay, so we can see that it just stands out, becomes very, very clear. Okay, that's what happens on the charts. And if you join me for the Tuesday morning 10 a.m. London real-time daily trading ideas, you'll see me very often drawing in these ascending and descending triangles and quite a lot of the patterns that we talked about here. We also looked at symmetrical triangles. I particularly like them. Okay, when I see price sort of coiling up like that, it means I'm getting ready for price to explode and make a move, and I want to be ready to trade that. And there again, there's another page that you can screen print, okay, and just print off and put on your wall, giving you a whole host of continuation patterns that you can draw on and sort of get ready to utilize in your own trading. Like I said, every week, the only way you get good at sort of identifying these patterns is actually to put in the work and go through your charts and do a little bit of analysis and draw them on. The more you do it, the better you become. Pretty much like anything you try to get better at in life. But then last week, what we looked at was reversal patterns, in particular head and shoulders, double tops and triple tops. We've already looked at key reversals, and we had a little bit of a look at those, okay. And if you remember, head and shoulders patterns, unfortunately, they're not always as beautifully clear as this particular diagram. But once you start to get an understanding of what you're looking for, you'll start to see this pattern occur across all instruments and all time frames. And then, particularly, we start to take an interest where we see the right shoulder forming, because that gives us the opportunity to get ready to take a trade in the direction we're looking for price to move once it's broken that neckline. Also, for inverse head and shoulders, it's the exact opposite of a head and shoulders pattern. You can see it there. Okay, second shoulders when we start to get interested. That's when we see that neckline break, and that is where we start to look at starting to create our trading position. And that's really what what we looked at. And as I say, as always, if you go back and get that particular chart on demand, you'll see that at a particular session on demand, you'll be able to go into these in more detail. Remember, this is just a quick recap week on week. We also had, double top and double bottom formations. Okay, particular favorites of mine. You can see it just looks like an M-shaped formation for a double top. If you remember, when we looked at double tops and bottoms, the double bottom looks like a W. Okay, and as I say, once you practice that, it becomes much easier and clearer to be able to pick up that particular pattern. And we also had a look at triple tops and triple bottoms, just another version of a double top and double bottom. You can see them there, okay? They become much, much clearer. And it's as always, it's when we get that breakthrough, the neckline, that is when we look to sort of establish our trading position. So there you go. There's a very quick recap as always. I appreciate I fly through it a little bit, but of course, as we're going through these sessions week by week, they're becoming bigger and stronger. There's more and more layers being added. And as I said, I go through it very, very quickly because every week I want you to hear it more, because the more you hear it, the more it's going to sink in, the more it's going to become your standard way of operating, your particular trading beliefs. But today what we're going to talk about is a little bit of a trading tactic, and I'm going to call it, which you'll hear me call it PO20, which is the power of the 20, and in particular, the power of the 20 period moving average. So what does it mean, and how are we going to be able to look at it today? Well, as I said, I'm just going to share a very simple trading tactic which uses the 20 moving average to confirm a reversal pattern that has taken place, and we'll show you a few examples of that. Follows on from last week's session on reversal patterns, and as always, I want it to be something very simple that you can take away and utilize in your own trading tomorrow. So, what do I talk about in terms of the PO20, the power of 20? Well, once a market has printed a reversal pattern, we use the 20 period moving average. It gives us confirmation that that reversal has occurred. We wait to see how does price react to the 20 period moving average after the reversal pattern. Does that 20 period moving average, does it switch? Does it switch from providing dynamic resistance to dynamic support? Because when that occurs, that gives us more confirmation that that reversal pattern is a credible one, and that gives me, more confidence in terms of placing my position. So what we're looking to do is to see, if the 20 period moving average starts to either act as a new roof for shorts, okay, it caps any further move north, or it acts as a new floor for longs, okay, it acts as, a sort of support. When that 20 period moving average acts as significant dynamic area of interest, then we have confidence to trade in the direction of the reversal. And that's what we're particularly looking for, okay? And you can see on this particular chart here, let me just bring up the drawing tools here. We've got a few examples here, but let's just show that here. We had a nice double bottom reversal pattern here. As I say every week, okay, I'm a better trader than I am an artist, so please bear with me on my drawing skills, okay? So hopefully you can see we have that nice double bottom there, okay? It doesn't, it doesn't really matter what time frame this is, what instrument this is, because these occur all the time, okay? It doesn't matter if you're a monthly trader on gold or a 5-minute trader on euro dollar, okay? If you can start to see these patterns, you can start to add them into your sort of inventory, you can utilize it when the time comes right. And what we see is, as I said, there's that double bottom. So, we might be expecting a bit of a reversal. But what we see here is, we can see the 20 period moving average, the blue, okay? Up here, ladies and gentlemen, you can see it acted as dynamic resistance, as it did here. It was resistance, okay? Price couldn't get above and close it. But then actually, after the patterns occurred, we see price push up and then price comes back down, okay? And what we can see is here is that, price, whilst it does pierce it, it can't close beneath it. Furthermore, the 20 period moving average is now turned and is starting to point up. And what we can see is that, it just can't actually close beneath that 20 period moving average. It has gone from being dynamic resistance to dynamic support, okay? That gives us, further confirmation that, yep, this market, this trend, this previous downtrend is over, and now we should be getting ready, okay, to sort of be able to trade on the move up. Right, and that's what we're looking for. And that's what we use the power of 20 to give us that sort of final confirmation. So pretty much like what we said there, we can utilize any of the price action setups we've previously discussed as trade setups. So in this particular case, okay, let's just get the pen in to help you. We've explained what's happened, okay, it's gone there, it's become dynamic support. But then actually, if you look here, okay, what we had there was, some nice rejection candles, some nice bullish pin bars, all right? That's what gave us our opportunity to sort of, get into our long position to be ready for the nice move up. And that's what we're looking for. It's a confluence of events. There's 3 or 4 things all happening at one time and place, and that's what we're looking for. So, sometimes it, what we can see here, I've tried to have a few different examples. This is the euro yen on an hourly chart. You can see price was going in an uptrend, okay? It put in not a very clear 1, 2, 3, okay, pattern. But what actually I'm looking for is, price comes down, it hits the 50 period moving average, it bounces up. But if you see now, ladies and gentlemen, it can't get above that 20 period moving average, can it? And actually what we have here, all right, there we have a bearish pin bar there, okay? We can see we've got a bearish pin bar there, we've got another pin bar there, okay? And what we can see is that, that the moving average, 20 period moving average is now sloping down, okay? It's gone from being dynamic support here to dynamic resistance here, and bosh, what happens? Price drops. And that's what we're looking for, okay? Just nice and simple, nice and simple. That's what we're interested in. This is an example on the weekly chart on oil. We can see that, you can see the price was in its downtrend here, okay? Then, we put in a double bottom. All right, this was a double bottom. We had, a nice W pattern, 1, 2, 3 pattern as well. Nice W pattern, okay. And then what happens is, price gets above the 20 period moving average, and now it comes back down to it. And now you can see it pierces it, but it can't actually close beneath it. And in fact, this becomes a really nice MRC. It's a momentum reversal candle. That the power of the 20 period moving average. And what do you know then for the next, what's that, about almost next 8 weeks, the oil price rises. Nice and simple. Nothing, as I said, trying to show different instruments, different time frames to show that these ideas that I share with you, they are time frame and instrument agnostic. That's the way I like to work. This is the Japanese Nikkei index. Okay, get the pen out. Once again, we had here the 21,000 level. All right, so we had a big round psychological number. Okay, that is going to be of interest. We can see price has been in a nice downtrend. Price puts in that nice double bottom pattern there. Okay, you see it happening time and time again. Once price gets above the 20 period moving average, we can see price. The moving average has gone from down to sideways. It's starting to curve up. And you can see here, okay, there was lots of pin bars here, a couple of pin bars there as well, okay, that were showing us that 20 period moving average was acting now as dynamic support and price was going on its way upwards. And that's what we're looking to position ourselves. So once I said, it's all about confluence of events. You've got a significant level of support, you've got a reversal pattern, okay, you've got the power of 20, then you also have, a price action signal. So there's 4 things alone there coming together all at one time and place. That's what I'm waiting for, and that's where I want to trade. This was another one on. I think this will probably have been the DAX. Okay, we've kind of covered this a little bit one before, but you can see downtrend. Okay, downtrend where the 20 period moving average has acted as dynamic resistance. We get a nice W double bottom. Price gets above the 20, price comes back down to it, and it just can't break it. And now the 20 period moving average is acting up, pointing up, and we've got pin bars. Okay, we've got pin bars here that are giving us the opportunity to get long and get ready to sort of take that nice move up. And that's what we're looking for. Confluence of events. All right, remember that's what we're looking for time after time after time. Here we have, this is, I think this would have been the probably the American markets, okay, probably the the Dow Jones here, okay, and this is just a much shorter time frame one. We had, we had a really nice uptrend. Price puts in a 1, 2, 3 reversal pattern. We can see price breaks that 20, it comes down, hits the 50. Once again, it comes back up to the 20. The 20 is now pointing down, okay. It's gone from acting as support to acting as dynamic resistance. It gives us the cap. We have, a bearish pin bar there. And what you can see is price just drops away nicely, nice and easy. Just a little bit of patience required, but it's worth the wait. So there you go, ladies and gentlemen. Okay, as always, I just sort of try and remind people that, as we move more towards sort of kind of mastering the 4 M's of trading in terms of looking at our trade setups, we're going to be focusing on 29 FX, okay, instruments. We've got the dollar index followed by the 28 other major pairs, okay, that we'll be looking at. So start to build a profile to add them in. We'll also be looking at some of the instruments, major indexes, okay, S&P, Dow, Nasdaq, FTSE, DAX, Nikkei, okay, you may add others if there's of interest to you. Commodities, we'll always take a little look at oil, gold, and silver. There's always plenty on there, okay. If you might be a soft agri trader, then by all means add that to your list. Equities, okay, certainly those big tech companies have been pretty interesting over the last few months, all right. There's been opportunities there. And then, of course, we nowadays have the opportunity to trade cryptocurrencies, okay, Bitcoin, Ethereum, Litecoin, Ripple, etc. They're now available on Admiral markets, and you can utilize and add them to your trading watch list. So, just to finish up, ladies and gentlemen, remember, it's all about managing the 4 M's of trading, markets, method, money, and myself. Okay, ask yourself that question: are they all in alignment with yourself? Because when they are, that's when you tend to trade at your best. If they're not, then you shouldn't expect outsized returns. Constantly monitor those 4 areas. So there you go, ladies and gentlemen. Just a quick record of the session on from Monday, 5th of November. As always, if you have any questions, then by all means get in touch with your account representative. You can give them a call on 020 7726 4003. Email them at hello@admiralmarkets.com. You can catch them on the YouTube channel Admiral Markets or on the Facebook page for Admiral Markets Global. So hope that's been useful to you. I hope there's been plenty there to sort of get you looking at the 20-period moving average. Okay, for those of you who want to learn more, as always, I deliver the Tuesday morning 10 o'clock real-time daily trading ideas. By all means, come and join me, and where I just simply utilize all the elements I'm covering in the Mastering the 4Ms of Trading and show you how I do that on every Tuesday morning. If not, then I look forward to you joining me for the next session of Mastering the 4Ms of Trading. And as always, I wish you the best of success in your own trading. Trade well, everybody.